Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time.
Silver's performance this year has been nothing short of remarkable. Up more than 40%, it is finally closing the gap that many investors mistakenly believed was evidence of lagging momentum. Instead, the metal is entering a technical phase where the spread between silver and gold is approaching multi-year breakout levels. For seasoned market observers, these spread dynamics are a critical indicator of directional conviction. When momentum builds in this way, history shows that silver does not move incrementally. It often surges violently once certain thresholds are breached. Michael Oliver, one of the most respected technical analysts in the commodity sector, argues that silver is now nearing such a point. According to his momentum charts, the gold-silver spread is pressing against resistance levels that have capped advances multiple times in recent years. If these levels are broken, Oliver believes it will trigger a significant technical breakout with the potential to reprice silver rapidly. His assessment suggests silver could enter a phase of accelerated gains, pushing toward levels that many mainstream analysts still dismiss as unrealistic. Gold, meanwhile, has also registered extraordinary gains this year, climbing nearly 40%. While its ascent has been steadier, Oliver emphasizes that gold's long-term driver remains the relentless debasement of global fiat currencies. The supply of dollars, euros, and yen has expanded decade after decade, eroding real purchasing power and reinforcing gold's position as money in its truest form. This degradation of value, he argues, is what underpins gold's sustained outperformance over the long run, regardless of short-term policy shifts or temporary interest rate adjustments. Layered onto this technical and monetary backdrop is Oliver's sobering view of the U.S. economy. He warns that the current equity cycle, inflated by unprecedented monetary expansion since 2009, has created distortions far greater than those preceding previous crashes. When reality asserts itself, he argues, the Federal Reserve will be powerless to prevent a breakdown. Just as in 2000 and 2008, rate cuts and liquidity injections may soften the blow, but they will not halt the correction. In his view, the severity of the bubble means that once the market turns, capital will again flee to hard assets, particularly gold and increasingly silver. In today's video, we will examine Oliver's insights in detail. First, his argument on monetary degradation and its link to gold's momentum, and later, his technical case for silver's explosive upside. If you find this analysis valuable, please make sure to like this video, subscribe to the channel, and turn on notifications so you never miss these critical updates.
A lot of people like to go day to day and they see a story and think, oh, this is important or this is important. In fact, there's a far bigger wave that's pushing gold. It always has. And that is the ongoing degradation of the money units. Whether you're yen, euro, dollars, whatever, they continue to degrade in real buying power because they increase the supply dramatically decade to decade, about 90% for the US dollar every decade. So, when your granddad built the house at $4,500, now it takes the same median price home, $450,000. That's called the degradation of money. So, it shows up, gold holds its value versus that ongoing degradation. It is money, period. And so other markets will also tend to try to follow the degradation of money, like stock market. But gold always, over time, continues to hold its value and outpace those other assets. And therefore, the interest rate issue. If the economy weakens, yes, the central bank will then have an excuse, justification to put full throttle on it again. They're always got their foot on the pedal. I mean, they're always printing money. They're always, money supply expands. Interest rates are arbitrarily set by a central governing body. It's the most essential commodity in human interaction between you and me, or me and somebody who makes a product in China or somewhere else. I don't know who they are. Don't meet them. But I like what they do. They like the money, okay? But if what we're transferring back and forth is degrading in value, sometimes quickly, if you're in Venezuela, for example, or Weimar Republic, you get the point. But governments deem that they have the right to control that essential commodity, quantity of it, the price of it, interest rates. And so you have a manipulated, effectively socialist money. And so wise men from above are deciding, and when they see an excuse to, print, they do. Man, they go crazy. Since 2009, actually it was October 2008, the Fed went to QEs. They took a chapter out of the Japanese book, and they started to go berserk, and they kept the 15 years since, 16 years now, interest rates were effectively at zero 10 of those years. And even when they raised rates during that time, and if you go back 50 to 75 years, you'll see that Fed funds rate was still in the lower quadrant of history. So they manipulate the money, and that's what causes gold to go berserk. And therefore, this data point that we saw today is merely another little excuse for them to go berserk. And, Powell to finally give in to the other voices on the Fed and to the president and all this stuff. Print. So gold knows that. That's why. Simple as that. It's a broader issue than just day to day.
Yeah. So in one of your recent reports, you showed that that the market may be turning over at some point, and typically what happens is the Fed comes in, they print money, they save the markets in this boom and bust cycle. And so in your recent report, you said this time it won't work. So I wanted to get your perspective there and dive into that a little more.
Well, in fact, it never really does work, because once they help create a boom through usually monetary policy, and you can see it in the money supply or the interest rates, so forth, the stock market will participate and enjoy the party, And then when the stock market tops, ultimately it's overdone reality for a certain period of time. It's overshot any realistic level, and primarily driven by monetary policy. And it breaks. And when it starts to break, reality takes over, and the Fed can't stop it. They never have been able to do that. You go back to .com, and that peaked. It was a laborious stock market top. It wasn't like a top and a collapse. It was for a year. You toyed around between January 2000, 2001, sideways. Made people feel comfortable. And in January 2001, about 6 months after the top tick in the S&P, they cut rates twice and continued to cut rates all the way down to 2002 low. Yet during that time, NASDAQ 100, representing the .com, dropped 82%. So they didn't protect anything. 2007 to 9, same story. They cut rates surprisingly. It was an ambush. September 2007, market went up, poked to new high right after that. Marginally, but made a new high, all-time high, in fact. That was the top. They cut rates all the way down. Market went down anyway. And it's going to happen this time. The only difference is if you stand back and look at 1994 to 2000, 2002 low to 2007 high, the duration was much shorter, usually 3 or 4, 5 years. And the multiple gain in the S&P, for example, is usually double, maybe triple, maybe a little bit more. But duration and multiple gain, there's no comparison this time. You go back to the 2009 low, and we've got a 10-fold advance in the S&P over 15 years, and we've got a 20-fold advance in NASDAQ 100. So dimension-wise, it's far bigger, duration-wise far bigger, meaning far more errors have been built into the system because of the distortion of the money unit. And in this bull bubble, we never had rates at free money, 10 of the 15 years, and low at the other years, lower than normal. And then the money supply also expanded rapidly. So you can understand why the bubble occurred. But once it breaks, reality tends to take over, and the Fed can take out all the hoses they want and turn on the spigot, and it just won't help. The money will go elsewhere. Where does it always go? Gold.
Oliver's discussion on monetary policy and the degradation of fiat units provides essential context for understanding gold's persistent strength. He makes the point that whether it is the yen, euro, or dollar, each has lost purchasing power at a staggering pace, often around 90% per decade. This long arc of decline makes gold's role clear. It is not just another asset, but the benchmark against which fiat erosion is measured. Importantly, he stresses that the Federal Reserve's interventions, whether through rate cuts or quantitative easing, have never been able to prevent a genuine market unwind. They can inflate bubbles, but when those bubbles burst, liquidity alone cannot contain the fallout. Against this backdrop, Oliver turns his attention to silver. Here, his analysis takes on a more aggressive tone, as he sees the metal's ratio to gold nearing levels that have historically triggered massive price acceleration. He highlights how silver's undervaluation relative to gold has created fertile ground for a sharp reversion. Technical spread charts now show pending triple-top breakouts, and if triggered, they could drive silver swiftly into the $60 to $70 range in the near term, with longer-term potential far beyond.
So many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold, okay? Though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years and plot it. We have a graph we put in the latest report. 2%, meaning divided an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11. Silver got up to 3.5 in higher price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, oh boy, you break through that and I'm going to blow the cork off this thing. The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metal.
So obviously with gold, we see central banks buying and such. What do you think are those fundamental aspects of for silver's?
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? Do you remember the movie The Big Short?
Yep.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table. Okay. That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point. Fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued, and demand is continually increasing. By the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid. It's no longer 20 cents. Okay. Anyway, there's a point at which the pain gets so bad that it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever. No, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt, and that creates fear. And when you create fear, tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
Oliver's projections for silver are particularly striking when contextualized within historical precedents. In past bull markets, silver has not only closed the gap with gold, but has often outpaced it significantly, with the gold-silver ratio tightening dramatically during peak cycles. Today, silver is trading at just over 1% of gold's value, a level he describes as abnormally cheap. If the ratio merely reverts to its long-term average of 2%, the price implications are staggering, implying a near doubling of silver's relative value in a compressed time frame. The industrial narrative for silver, while secondary in Oliver's framework, cannot be ignored. Silver is critical in solar production, emerging AI technologies, and advanced electronics, with China alone consuming vast amounts for its solar sector. Supply, meanwhile, has plateaued, creating a structural imbalance between limited new production and rising global demand. Although Oliver cautions against relying too heavily on fundamentals for timing, the industrial squeeze provides an added layer of support that could sustain silver's bull market once momentum takes hold. For gold, the drivers remain more monetary and geopolitical. Central bank accumulation has accelerated over the past several years, signaling an institutional recognition that fiat systems are under severe strain. In times of monetary dislocation, central banks themselves act as the bid, reinforcing gold's floor. Silver, in contrast, benefits from both the monetary and industrial sides, making it uniquely positioned for asymmetric upside in this cycle. Investors who dismiss silver as a laggard risk, overlooking its historical role as a high beta counterpart to gold. The broader implication of Oliver's analysis is that the financial system itself is approaching an inflection point. Prolonged reliance on artificially low rates and ballooning balance sheets has left the Fed without meaningful tools to contain a downturn. Should equity markets unravel, as Oliver suggests is inevitable, capital will reallocate to assets outside the reach of policy manipulation. Precious metals, particularly silver, given its undervaluation, are poised to be among the primary beneficiaries of this shift. As always, the challenge for investors is timing, but Oliver's technical framework provides clear signposts. The pending breakout in the gold-silver spread, coupled with silver's momentum, suggests that the window for accumulation may be narrowing. For those positioning ahead of the move, the coming months could offer not only protection against monetary degradation, but also extraordinary upside potential. If you found this analysis helpful, please give this video a like, subscribe to the channel, and share your thoughts in the comments below. Where do you see silver heading in the next cycle? Thank you for watching, and stay tuned for more deep dives into the dynamics shaping the global financial markets.